spokesmodel is otherwise occupied tonight. So get me.
Oh, that's not me. That hurts, man.
Second Street.
Ah.
Bring in the Second Street. And I apologize. I was actually a little late tonight. And we've got a lot going on. I didn't even change my clothes tonight. I've got issues with my father and health and hospitals and such, and 2 trips down to the city today. I wasn't going to bug out because I was afraid that Jeremy might show up on my doorstep with a couple of puppies.
Yeah.
Here, they're yours. Sorry you weren't there tonight. So I came anyway. But who thinks like insurance is a product of the big conglomerate, the corporate money grabbers? No? You do?
Yeah, a little bit.
Well, it's not new, but it is a product of the big corporate money grabbers. However, give me a guess on when the first insurance policy was. Ever.
It's got like BC.
No clue.
I have no idea.
Yeah, BC.
The folks who got together and provided coverage for the merchants who were sending ships overseas.
That was actually, yeah, in 1300s in Genoa was the actual first policy or contract. But the practice of insuring goes back to Babylonian times, 2,000 years before Christ, BC.
Yeah.
Where the trade merchants and they would get someone else to assume some of the risks on the trade routes in case bandits and that kind of stuff happen. The first actual company to insure is still in business today. That's Lloyd's of London. They are not actually an insurer in the sense they're not a stock company or a mutual company. They're a series of syndicates it's basically they're a syndicate where they'll match a buyer to a seller. So large money investors can actually they're considered underwriters, and that's where the term underwriting comes from. If someone would say, I've got this shipment, I want to insure this, and then the people that wanted to take a piece of that risk at the bottom would write their name and the amount of risk that they were willing to assume. So they were called underwriters. A little trivia. Yeah. But Lloyd's it was a Lloyd's coffee house. And that's where the name came from, where merchants and shippers and would gather to do business like in London. So it's been around for a while. There's been a few changes since then, but people still insure shipments, obviously. Insurance is actually, it's the definition of insurance is it's a contract. An insurance policy is a contract, but it is a means of transferring risk from one to another via a contract policy. And then to indemnify it, indemnification is to make whole in part, or to make same in whole or part via payment or replacement or repair what a person has lost. So that means what it is to indemnify. But actual insurance, a lot goes into determining what a company or who's going to charge, what they're going to charge you for insurance. You have these what they call actuarials, mathematicians that use the formulas and laws of diminishing results and laws of averages and pooling large to determine what a percentage of a risk is for specific. And then they use different with different formulas. So because they determine risk premiums based on base rates, but there's a lot of variables obviously. Location. Those with people and try to insure in Detroit are familiar with that, aren't you? Across 8 Mile and your insurance goes up 40%. But that we can still do that. But there's a lot of others as well. loss history, if you've got a history of loss. Obviously, we call, what do we call that? I can't remember. Protection class. There's 10 different protection classes that they'll do. Detroit all of Detroit happens to be a 2. Southfield is 4. There's others, but that's all based on a number of factors, which is fire hydrants, municipal water. Is the fire department volunteer or is it paid fire department? Is it a shared fire department? This kind of thing. Distance to water. If something's on well, there's not fire hydrants, they consider the distance to a water supply as well. So that actually goes into the rates as well, that determination. And this is very controversial and it's been fought many times, but they do use credit rating in personal lines. Typically, commercial, we don't use credit ratings, but personal lines, and it's been through court numerous times. The insurance companies have managed to prove that there's a direct correlation between credit rating and claims, amount of claims. And they've been able to prove that in court numerous times. Michigan is one of the states. Not all states use credit rating, but Michigan has always and continues to use credit rating in personal lines. For your home, auto, anything, and we call it personal lines. Commercial lines is totally separate. I'll get into that a little bit later because I use both personal lines and commercial lines for insuring rental properties as well. There's different types of companies. The majority of the insurance companies is a stock company. It's for profit. You can buy stock in the company. And it's run just like a business. But then there's also, and this is about maybe 20-25% of insurance, you've heard mutual, the mutual insurance company, Mass Mutual, and the other mutual. And the best way to describe that is the members, the insureds, own the company. It's like a credit union, basically. So all profit is not, it is a not-for-profit business. Does it mean lower rates? No, not necessarily. It's all about management and managing their own risk. If they insure a bunch and they have a lot of losses, well, then the losses as well are passed on to the members in higher rates. So there's two. I don't think one's better than the other. The majority of what I use are stock companies. Mutuals tend to be what we call captive companies, like a Allstate or that, where an agent would just work and write just for that company. Mutual companies don't typically go through independent agents as well. There's also the Lloyd's Syndicate I mentioned earlier, which is neither stock or mutual. And then there's the government. Government's a big insurer. Unemployment, that's insurance. That's government mandated and administered. So there's a couple others. Workers' compensation, flood insurance. Those are federal programs, but those are marketed and administered by private companies. So the government basically underwrites the risks and pays these companies to administer and market them, because the government has no way, they would have to establish a whole new infrastructure, to go into the government flood insurance office. I don't think anyone would want to do that. Flood, actually, interesting. I'll just bring up flood insurance. I insure 2,000 rental houses, apartment buildings, commercial buildings. There's some on the east side. I haven't gotten into it, but very few. I have not run into a flood where I have had to provide flood insurance. I can do it through some of my companies until about 3 weeks ago, when FEMA came in and remapped Wayne County. And now parts of Romulus are in a flood zone A. And the way we find out is the banks forced place flood insurance and charge the landlord an extra $800 a month or a year on that. I go to the same thing, I quote them, I go to the flood, costs the same, but it's mandated. Now, if you own the property outright, cash, that's your choice whether you want to have flood insurance or not. But if there's a mortgage on it, the mortgage company will demand that you have flood insurance as well. And that just kind of surprised. Romulus, I've never heard of Romulus, a flood in Romulus, which is strange. And I'm sure I'll run into some other areas too, Taylor and along the road and some areas. I have run into it on the east side along the lake as well, but I've never had to. No one's ever demanded that we get it. It's all by shore. Speaking of choice, why do we insure? Why?
In case something happens.
In case something happens. Well, why?
They protect you.
In case something happens, what is the result that you're looking for?
You talking about if something happens, the result
Yeah.
to get reimbursed for
Reimbursed.
money
Right.
lost.
So you're looking for someone else to assume the risk, and you're going to pay them a certain amount of money to do that, to make yourself whole, cover. How much can you, if you buy a house for $35,000 cash, you don't insure it, the place burns down, how much can you lose?
Oh, it's already spent. Actually, it costs you.
Well, yeah, how much can you lose? You can lose your investment, right? Your 35 grand.
Yeah, at least you might have to
And
tear it down.
then
too.
you'll have to,
Yeah,
you know,
demo.
debris removal and demolition, and they'll come after you for that. So you're limited on the amount you can lose. If you rent a property, someone's walking up the front step, the rail gives way, they fall down, they sue you. How much do you stand to lose? Everything you have. Everything you have. A lot of people will say, well, how much can I insure it for? How much can I, insure that? What do I need to insure that? I only paid 34 grand or 35,000. I don't want to insure it for anything more than that. It's like, all right, well, don't focus on the property. We can deal with the property. You basically ask, how much are you worth? Okay, well then we want to cover, A lot of people will do, and I talk extensively about this to my clients, well, don't worry about it, it's an LLC. Do you think that protects you from liability?
If you do it right.
Depends.
It can, exactly, it can. It can protect you. To a certain extent, some people put each house in a separate LLC.
And then mingle with funds.
And then commingle the funds. And that's exactly, because if you commingle any funds or pay for anything out of your pocket, or pay for taxes, or pay for a $25 thing at Home Depot, you blew the whole thing. That's breach of that. The lawyers will get a hold of that and said, the only reason that you have an LLC is to avoid liability, therefore the liability lies with you no matter what it's in. So you just got to be very careful. I've got clients that hold 25 houses in their own name and have a $5 million personal umbrella. Yeah. And that's, you're just as safe, or you're just as protected with that as if you try to do a lot of different things with LLCs and getting away from it. You're still exposed, but it's a personal choice. A lot of people, obviously with partners, if you've got partnerships, you're doing deals with other people, a company, liability, S corp is the way to go. You're sharing that liability, and it's not tying. But be sure that you operate each one as a business. And that's so I've got all these LLCs, each house in a different LLC. So you've got 25 different bank accounts and 25 different everything. Everything's got to be done separately. And then, right, as far as tax purposes, right?
Yeah.
Everything has got to be filed separately as well.
It should.
Yeah, it should be. In particular. So, they're thinking, I don't know, that could seem to me like it would be kind of a hassle. But that's why we insure. That's really why we insure. And I talk extensively with my clients about that. you know, what is your exposure? You know, what is your exposure? Typically, on any landlord policy, discrimination is excluded. We'll talk some of these. Discrimination coverage is excluded. So if someone sues you for discrimination, and that's on you. That's not on the insurance. That's an act by you. Professional property managers have what we call, they have general liability. They have professional liability, errors and omissions. That actually some will cover $25,000 in discrimination. You can buy in an additional. I've talked to a lot of them. It's like, you know, they see $25,000. They say, okay, we'll settle for that, you know, type of thing, because that's how much coverage they have. But that is affordable or available, but it's not on an individual or an LLC, or you're just getting a policy to cover. That is typically excluded, as is lead paint. Lead paint liability would be excluded on these. Bacteria, mold, anything like that, excluded. You cannot insure against that. Some will have what they call limited mold coverage. But in this litigious society, lead is an interesting thing, because just the fact that there's lead paint in a house doesn't make you liable. Now, if you, I'm not an attorney, this is what I've learned, if you neglect that house, and you don't paint that house, and the paint starts peeling, and you rent that house in that condition to someone, and the child eats some paint chips, you are liable. They can come after you for that, because you are responsible for the upkeep of that house, and you rented it to someone where, with that exposure, knowing that that exposure is there. That's what I actually just had one of those not too long ago, and I squeaked out of that one because the guy called me up. He said, "Yeah, they're suing me and my property manager." And this guy was from California for lead paint. You know, and they came in, and I said, "Oh yeah." I said, "Well, what was the date?" It was going back 2 months before I wrote them. So it was on the old insurance policy. Whew, it can be a big one. But, you know, again, that's part of the liability also, though. And that is what I like to say. All right, what would it cost you to hire a lawyer to defend? If you decide to self-insure your property, which is completely fine. You say, I'm just going to insure my property. I self-insure it. I've got 25 properties at 30 grand, and it's going to cost me this much. And so I'll take the chance. If one burns down, I'm out that much money. But as far as the liability goes, if you're going to self-insure, what would it cost you to hire a lawyer, even to look at the case?
$2,000 retainer, $250 to $500 now.
Liability only insurance policy, I can get for about $400 a year. Which first dollar defense, which means the insurance company hires a lawyer to do all this. So, you know, in that case, and I've got some clients that will do, you know, just liability only on some of their properties. Most of them will do what we call catastrophic coverage. We can insure typical insurance on a property. The settlement is either replacement cost or actual cash value. Replacement cost is just what it sounds. Cost of repair or replace, bring it back to the position that you were in. Actual cash value, or ACV, is defined as replacement cost less depreciation. And this can get very complicated because everything in the house depreciates at a different rate. The roof depreciates at a different rate than drywall or wet plaster. You know, kitchen cabinets depreciate at a different rate than hardwood floors. So, what in the case of a claim under an actual cash value, the adjuster actually comes in there, line items, every detail on all this. Here's the replacement cost. Here's the industry standard. And they use industry standards as depreciation, but they have to estimate the age. The adjuster estimates the age and then applies this percentage to each of these. So they'll say, all right, here's the replacement cost, less depreciation. Here's the actual cash value of the damage. Now, what we run into with that is typically, what's actual cash value? Without having all these formulas and knowing the age of every different thing and sit down and figure out, how do I figure out what my actual cash value of my house is and how much I should insure it for? Typically, we look at $50 a square foot. Some will go down $35 a square foot on a 40, 50-year-old house. Newer houses are going to be upwards of $80 a square foot. Just let you know, I mean, replacement costs today, and insurance companies, they don't care what it costs to build something, to hire someone to build you a new house. They don't care what it costs you to hire someone to come in and put a new kitchen in because the guy's working, on the side, and he's a brother-in-law and this and, I can get this for that. They don't do that. They use basically standard rates, industry rates, and replacement cost is on a basic frame house or even a brick veneer house built in the 40s, 50s, 60s, $140 a square foot for replacement. So you're looking at, so you buy something for $40,000 to insure it for $140,000 to get replacement costs. Well, there's something a little different there. And then the insurance companies look at that too. And they say the difference between what you paid for it and what the replacement cost is huge. Well, they call it a moral hazard. Is the official term for that. A moral hazard. And when a lot of they have clauses in the replacement cost too that will say, if it is replaced or repaired, we'll reimburse you for that. If it is not replaced or repaired, you don't get a check for the $140,000. It reverts to actual cash value. So you can still get a check for $50,000 or $60,000. But obviously, there in the last 5 years, typically really hit about 3-4 years ago. Tremendous amount of fraud in the city of Detroit. Tremendous amount of fraud. Guys buying something for nothing and insuring it and just hiring someone. The firefighter was killed, and they determined that the owner, the landlord, this was 2 years ago, paid this handyman $25 a torture case, and the firefighter lost his life.
How did they find out, like, that's what he did? Like, they investigate all that stuff?
Yeah, absolutely. Oh, yeah, absolutely. Yeah, they found accelerants on the scene, and then they actually interrogated, and somehow they got a hold of his helper, and he pleaded. He pleaded and turned against the landlord. But there's been a tremendous amount of fraud in that sense. So the insurance companies are leery as well. But insurance companies are in the business, most of them, of making money, but they're also in the business of restoring what you paid for. I mean, it is a contract, and they have a contractual right or a duty to pay these claims. Which kind of brings me to another. Before I leave that, Jeremy had talked about clauses and such. Particularly when we're insuring for actual cash value and replacement costs. You will see agents that will insure, and I've seen this numerous times typically with captive agents and standard companies. They'll insure a house at replacement cost for $100,000 or $80,000 at replacement cost. Get that premium down, and they'll get by. But the problem with that is, if something happens, and then we call it an E&O exposure, because this could come back to the agent at some point. But if there's a claim, that insurance company can claim that house was underinsured. And they have clauses, they're called co-insurance clauses. 80, 90, or even 100% co-insurance clause, which means if you do not have the house insured for 100% of the replacement cost via their models, and a lot of them now, what they're going, actually, they're sending out for appraisals on these insurance companies, right? Are you doing any of those?
I've done a couple.
Have you?
Yep.
Just to verify,
Yeah, I
and
did
then
a
they'll
fire-
come back.
Yep, I did a fire, half burned down house.
Did you?
Yeah, because they said it was underinsured,
Yeah.
so.
And what they'll do is they'll come back and they'll say, particularly if it's 100%, which is actually worse than 80%. If you don't have it insured for 100%, they'll determine how much you have it insured for using their models. So if you have it insured for 60% of what they think you should have insured it for, you're only getting 60% of the damage in your claim. And then you're paying for replacement cost coverage. So it's very tricky on that. Typically, I mean, I don't do much at all on replacement costs, particularly with investment properties, because the difference between replacement cost and purchase price market value is so great that we typically do it at actual cash value. A lot in the city. I mean, to insure a house in the city right now in Detroit, you buy it for $35,000. If you were able to get replacement costs, the numbers would probably be about $5,000 a year in insurance on that. So it's a little cost prohibitive. So we typically insure at actual cash value, but there's normally an 80% co-insurance clause on those too. Now 80% means you only have to insure it for 80% of the value rather than the 100%. But still that kicks in. So we look at this as there's no co-insurance on the liability, obviously. It's on the property end. So we kind of look at that. We weigh the premium versus the risk. So, and that's exactly why they call it co-insurance, because you are co-insuring your own property, meaning you're assuming some of the risk yourself. You're not transferring 100% of that risk to the company. They're assuming you're retaining some of them. So say if there's a $10,000 kitchen fire, on a house you bought for $35,000, insured for $50,000. After deductible, and they determine that you've only got insured for 60%, you may only get $6,000 on that. But $6,000, you can put a decent kitchen in it, because again, that's market value for where they're determining the value at actual cash value, replacement cost, their replacement cost, which is typically higher. Then you can get your handyman or your guy, your contractor, to throw a new Home Depot kitchen in place. So I really try to counsel people. It's like, well, how much are you assuming your risk? If you're looking at strictly at premium, and a lot of them do. I'm calling around to get different premiums. And this I'm going with this one because it's the lowest premium. Well, it might be very well the lowest premium, but it may not be the same coverage. Or the agent may not explain that there's co-insurance on this, and you're going to be having to put out some out of pocket on anything less than catastrophic coverage. Also, if you have multiple properties, because remember when we talk about determining premiums, loss history is part of what determines premium history, or your premium, your loss history. So if you start putting little claims in for a lot of little stuff, you're going to get reimbursed, you're going to get some money back. But then your premiums, the next one you go to insure, why is this 40% more? And renewal, on top of renewal, the renewals come in. Why has this gone up so much? Because you put in some claims. You've hit that actuarial table, so you go from this column to this column, and this column is a lot more than this column. So yes, we do absolutely, sorry about that. My finger's wet, it's not working.
Done with that?
Yeah.
Set it on the ground and step on
I've been
it.
tempted.
It works every time.
I've been tempted lately. Drop in the toilet, that works too.
Is it insured?
Yes, it was.
Get a new one. Doesn't work, drop in the toilet.
I got a new one. $80 copay. Deductible. What do they call it? Yeah, $80 deductible. So yeah, you know, it really depends, and that's why I work with my individual, you know, people. We got to keep and a lot of them. I mean, you're business people. You're business people. You're in this to make money. This is not, you know, your home, whether it's a place to live or your cars. And this is a business to you, whether you own one house or you own 40 houses. It's a business. Why did you buy the house? To make some money, right? It's a business. It's a business. So treat it as such. And there's costs of doing business. And you want to maximize your cash flow and minimize your risk. So each person has different thresholds for that risk ratio. You know, some people say, I want $500 dog, I want low deductible, I just want to know this. Okay, and then they're willing to pay the higher premium on that. Others take more of a long-term approach and say, yeah, I want to be covered, I want to be covered for catastrophic. You know, if the place burns down, total loss, I want to get my investment back out. Or liability, you know, I want to be covered for liability as well, certainly. But you know, I have people call me all the time, you know, and ask me that, and they focus on the premium, they focus on the amount to insure, and low deductible, and I basically give this speech to a lot of people, you know. So I ask questions. Why are you getting insurance? Well, my lender is making me. Oh, okay. If not, you know, why? What are you looking to do? Because I can do it, you know, a number of different ways. So treat it as a business and look at it as a business, a risk-reward ratio. Suburbs versus the city. We can get into a little bit of that. There's certainly absolutely not as much available in the city. But we can look. I gave you some handouts. I don't know if you saw that. Basically, there's different forms. We call them forms. And it's basically different levels of insurance. You know, a lot of times you hear basic form, Michigan basic form. Basic form is just that. And we're not talking about liability on these at all. This is just property insurance. Basic form insures for what? Anyone know?
No. Sorry, next question.
What does basic form cover? Basic form, DP1, dwelling policy 1. Fire, lightning, and internal explosion. That's it. Car runs into the house, tows the house, drunk driver, you're not covered. Plane crashes into it, you're not covered. Get 3 feet of snow, the roof collapses, you're not covered. I mean, it's basically, a lot of people just refer to it as a fire policy, because it's basically what it is. I do some of those. That's all vacant houses are all DP1s. Basic fire. You cannot get anything higher than a basic form in a vacant policy. DP2, we don't see this too much. You'll see it in which we call broad form. All of these different levels are similar in personal lines or commercial lines. We just call it different things. It's a DP1 or in personal lines or basic form. Commercial is basic, broad, or special form, or rental house landlord insurance is DP1, DP2, or DP3. DP2, which we really don't see too much, they call it extended coverage. It includes basically just about everything you would think of. And there's a whole list here. You know, weight of ice, snow, sleet, accidental discharge, water, or steam, not flooding, sudden accidental tearing apart, cracking, burning, bulging, freezing, sudden accidental damage from artificially generated electrical brick. A few other things. But it's all named, we call it named peril, because it's gotta be one of the things that they name. The majority of what I write, even in actual Cache Valley, even in the city, is what we call special form. And that means anything is covered other than what is specifically excluded. And there's a whole list of exclusions, so typically bacteria of the land, terrorism, acts of war,
Riots.
theft. Theft is excluded. Typically. A lot of people don't know. Now, historically, when someone steals something, what do they steal? They break into a house and steal stuff. What do they steal?
Personal property.
Personal property. The TV, the stereo, the computers, stuff that's laying around.
Furnace. The copper.
Traditionally, they don't steal part of the house.
Not until now.
Not until now. Not until now. So theft has always been excluded. Now, what you can do is you can add limited theft, but that's just for personal property. If you as a landlord own the washer, the dryer, refrigerator, anything that's not permanently attached, that's considered personal property. You can put theft coverage onto that. I just did one the other day for $3,000 in personal property. A little cost prohibitive. They wanted another $100 a year. But that's, that's not too bad, but still, it's like, I'll just, I can go down and get a used refrigerator, so don't worry about that. That's what they said. But theft is, excluded because theft is typically, historically, what they take. And what they take is normally what they can lift up and carry out without having to bring a hacksaw and a sawzall and wire clippers and big shears and tear out. But the damage that they do to the house is typically covered under a special form. That's considered vandalism, malicious mischief. So, guy comes in, kicks in the door, or, I've had this happen, hooks a chain to the security door through his truck, pulls it off the house, goes in, kicks out, takes his sawzall down the aisle so he can get another 3 feet of copper out of the walls. The damage that they do to the house is covered. But what they take, anything they take off the premises is not covered. So the furnace itself, the copper itself, the materials are not covered. But typically the damage, under a special form, the damage that they would do to the house in order to bring it back is covered.
Okay,
Yes,
like,
Aisha.
with the personal property, that's just like the appliances that I would have paid for in the renter's house, not the
Correct.
actual renter, because they would get renter's insurance
Correct.
or something? Okay.
Correct. You don't want to insure their stuff.
Right. Okay.
Right?
I was just making sure it's why I
I mean, you
asked.
pay. And that, well, that's another thing. I want to just bring up, some clients demand, landlords demand that the tenants have renter's insurance. It's a good thing. Because a lot of people don't know that part of a renter's insurance policy is what we call fire damage. Damage to others' property rented to you. So if that tenant causes a kitchen fire and has a landlord policy, typically up to $100,000 is covered under their insurance policy. You don't have to put a claim in. The renter's insurance policy will pay for the damage because they caused the fire.
There you go. Something to add to your leases.
So some, I have some that, that's part of right of their lease. You must have a renter's policy and name the landlord as additional insured. Some do that.
I've got that one more.
It's tough. It's tough. I mean, a lot of people don't do it, And I will say a minority of my clients do that.
I've
Demand
had
it.
some
insurance agents give me a hard time about being named as additional insured.
Well, actually, you cannot be named as additional insured on the property itself. You are automatically
On the tenant.
on the tenant's policy. Technically, you cannot be, because you don't have, it's tough, because you don't have an insurable interest in their property.
Is there a way that I can get that, do I need to have my name on there?
You don't need to have it, but you want to, in that case, what you want to do is,
State Farm, and
you can also be
I had a
named-
3-hour fight with State Farm once.
did you? You can be named, Jeff, is what we call a certificate holder. You're not a named insured on the policy, but you're a certificate holder. So we typically do this mainly in commercial policies. But that just means that you're a certificate holder, which means you have proof of insurance. So if they let that insurance lapse, the agent has to contact you and email you.
I've gotten that.
To let you know,
They
and that-
send me the notice. but-
Right.
but
Then that's
not on the
good.
policy.
Yeah, because in the policy, basically, there is that coverage which protects, we call it damage to premises rented to you, which would,
So does anybody, you know of anybody who actually will write the?
no, only as on liability. Some will do it on liability. Some will do it on liability only. But they don't like it. They don't like it. No insurance companies.
It was not a fun conversation.
No, I bet it wasn't.
We would do.
Sorry, Mr. Rabinovich, that's against company policy.
It got loud enough that my wife had to leave.
It's tough. There's agents that will actually just kind of do it. But I don't even know if they'll hold up sometimes because
Do you do it? If somebody's,
not on property. I don't do renters. I don't really do. I refer all that to other people. So I haven't really run into that much. But consequently, just as your policy doesn't cover their goods, their policy does cover. It's different. Your policy does not cover anything of theirs, but their policy typically would cover their liability against damage to your house by something they caused.
That's why I don't.
Yeah.
They also have a dog. I require one of their animals.
That's a good point. Dogs. Dogs, you said?
Yep.
Dogs.
For the liability.
Yeah. Breeds of dog. Typically there's a list of dogs. Pits,
They're all
chows, German shepherds. I mean, just go to Jeremy's house and you'll see. Gina, line them up. These are the dogs we don't insure. And anything a mix, wolf hybrid, you know. Wolf hybrid. You don't see too many of those. That was kind of a craze in the like 80s, 70s, the wolf hybrids. Remember those? But what they'll do is they'll let you have a tenant there with one of those dogs, but they're going to endorse that policy with a animal liability exclusion. Which is another good reason to have renters have a liability policy, a renter's policy. And typically, for, say, someone's got $30,000 of goods in their house, you know, they can go to a State Farm, they can go to Allstate, get a renter's policy to cover their $30,000 and $100,000 in liability for $400 a year, you know, and it's, you know, I would encourage you to do it. I don't know that I would, you know, demand it, but it's nice to have. Because your liability coverage does not extend to, you know, the owner. And obviously in court, you know, even if you're aware that they have a dog, you know, you may be aware, you don't want to know if it's got a bite history or not, because then you can say, you know, you don't want to ask them if it's ever bitten anyone, because if they say yes, then if you ever have to testify and they ask you, did you know that dog had a bite history? What do you gotta say? I never asked. But your liability does not extend to them, because they're the ownership of the dog. They're in the possession of the dog. That is not your liability. That's their liability. If it bites someone or such. Oh, but yeah, additional coverage, we talked about that. We just talked about the personal property. Loss of rent coverage on these policies, loss of rent. And this is confusing, and I've had many people ask this. I think of it as it's business income is what we call it. We call it business BI coverage, business income. But it's not if a landlord or a tenant skips out and skips you for 3 months rent. You can't insure against that stuff. They won't do that. I've had people ask, oh, really? Well, what's it for then? Actually, it's typically foreigners that ask me that question. Because actually I heard in Australia, you can get an insurance policy that will insure against that.
Really?
Yes.
Great. Wow.
Yeah.
That's cool.
Here you cannot do it. But what it does cover is, if there's a kitchen fire, tenant has to move out, they can't live there. Part of your claim is that loss of business income. So if they're not there for a month, you get $850 a month rent. Part of that claim is $850 a month of your lost income. It's nice coverage to have, just for cash flow purposes. And typically not very much. We normally do it at 10%. You know, if we insure a house for 50, 10% will be business income, loss of rent coverage, $5,000, and some of the clauses. Well, they don't just give you $5,000 what you claim. There's typically quarter monthly limits, so it means you can't have any more than a quarter in a month. So it would be $1,250. Quarter of that $5,000 each month is the maximum. That type of thing. So it depends on what you get. A lot of people say, well, I want a year's worth at, you know, I get $1,200 rent. You know, I need $14,000, $14,000, $400 worth of rental income. So, well, what are the chances of it taking you a year to get a house tenantable again? Not very. I mean, you're going to want to get that thing, unless you're sitting back and going to the insurance payments. It's like, I don't need to fix it. I'm getting insurance. I'm getting the insurance. I'll wait 4 months and fix it then.
Now what if like you said with the tenant, if they had to move out for a month because of fire damage, would you pay for their like hotel stay or something?
That's all up to you. It's all up to you. And that would typically be and it's probably not covered in most rental lease agreements. You have no contractual obligation unless it is in your lease to do so. It wouldn't be covered. I mean, you could take that money. I've had clients that, you know, move someone into one of their other houses for 2 months that they had a vacancy on, live here, you know, continue collecting the rent. So I guess you could collect rent on your other house and the rental income on this one. You didn't hear that from me. But yeah, I mean, technically they're two separate, you know. That you're losing the income on the other one, potential income, because you put them into it. I've also had people put them on temporarily in hotels. You know, clients do that even. But that's up to you. But that is not part of the insurance. Vandalism, malicious destruction, we've talked about that. Typically on any special form that I do, even on my basic vacant policies, I will add vandalism, malicious destruction. So not only do you have the basic fire, but you have vandalism coverage on those as well, which is always nice to have. The vacant house, back up the sewers and drains as well. Some of you may have finished basements. Sewer backup it's typically excluded on any policy, even a homeowner's policy. If that water backs up into your basement, insurance company says, hey, it's all right, that's excluded.
How about sump pump?
Sump pumps, sewers, drains, sump pumps, they call it. It's treated actually as, they consider it flood. Because it's natural, it's nothing you did in the house. If a pipe bursts, freeze and bursts, you're covered. But if the actual public drain or sump pump or backs up. If you have a finished basement, it's a good idea to have that coverage. Typically, there's maximum of $5,000 coverage on that type of coverage. Costs you another $75 a year maybe, with $5,000 worth of coverage. You know, if it's not finished basement, theoretically it could damage, you know, furnace and water heater. Some of my clients have it. I explain it to them. Some want to say, I don't need that. I don't want to pay for that. What are the chances of that happening? Famous last words, right?
Yeah, right.
What are
Famous
the chances of that happening? That's never happened. We've never had a flood in my area.
My mom had that happen, and insurance coverage, she had the coverage, they came out, it was actually a collapsed sewer line. They came out, dug it up, put a new one in, they moved everything out of the basement. Did all that and then paid to move it all back in.
Nice.
Covered everything.
It pays, sometimes. All right, I don't know where we're at here. We're about ready for questions, I think. How long what time am I doing that?
Wrap up anytime you want to, question and answer.
All right, another, and I know some of you do this, this can be the most economical way to insure your rental properties. If you have, go to the company that you've got your home and auto with. They typically limit the number of rental properties that you will allow. Most are 3, 4, some 5. But they have to be in your name. They have to be in the same name. Typically, you can maybe add it as LLC, but then they consider it a business, a commercial, and it's not part of yours. There's advantages. I've seen some extremely low rates on those. They want the underlying coverage. Allstate will do this and the other. Safeco, I write with Safeco, I can do that. But it's tied together. So say if you've got some rental properties and you do have a claim, it's all tied with the same company, the same, your homeowner's rates are going to go up too. So it's kind of separate as well. But it is advantage. I mean, I've seen some very good, in that case too, if you do have them in yours, under that, a lot of times those companies will write a personal umbrella as well. So you can have your homeowners, you're the smart, Jeff. Yeah, yeah, we looked at it, yeah. And he's got a great deal. You get your home auto, your rental properties, personal umbrella. Safeco's one of the companies that will do all that, if you've got all of them in your name. And they do a really nice job. I like that. But that's an option. A lot of people don't want, they want it separated, they want it total separated, separation.
You can get bigger deductibles when you bundle them too. I think
Pardon me, Jeff?
You can choose bigger deductibles when you bundle. I think when I started
Sometimes.
bundling them, because I raised my deductible.
Right, you got 2,500 now or 15?
$5,000.
Oh, okay, yeah.
But that's why I found it. That's why my
Right. And you've got an excellent lot, so you've been with them for a while.
I don't think many.
Right.
I'm not gonna
What do you think? $400 a year?
for something like that. $400.
400 or 500. You can't beat that. You can't beat that. You know, that's one option. But I do both commercial and personal lines. Actually, right now, for properties in the city of Detroit, there are no companies left that I have that will do it under a personal lines. It's got to all be commercial properties. And those commercial, there's two different kinds of insurance we have, two companies here, and each state is the same. In the union, we have what we call admitted companies, or we call them standard companies. All of the rates are filed and approved by the state of Michigan. All kept on record. They cannot deviate from those rates. And in return, they actually contribute to a pool in the state of Michigan where catastrophic claim. So basically, if one of these insurers goes out of business, goes bankrupt, and you have a claim on your house, the pool, the state of Michigan, will actually guarantee those claims. We call it standard companies. There's other companies that insure, and they typically insure not so standard risks. Different kinds of businesses as excess and surplus lines, which is all commercial. Excess and surplus lines, they don't have to file with the state of Michigan. But the state of Michigan still charges a tax. So if you don't file, if you're not in compliance with the state of Michigan, if you're not admitted, okay, you don't have to contribute to the fund, or we're going to tax it. So there's a 2.5% tax, surplus lines tax on it. And they're not guaranteed by the state of Michigan, but AM Best, there's financial rating out of insurers. AM Best is one of the biggest. They'll rate insurers A, B, C, A, B, A minus, A, B, B, C, in financial strength. I don't write, and my E&O, my professional liability insurance, will not let me write with a company that's rated less than B financial strength. I typically don't write anything with anything less than A minus in financial strength. So, the chance of these going out of business before we know it or are aware of it and can switch it is pretty slight. So, and particularly when you're looking at, they're the only ones that will insure the property, that's where we have to go. But the state of Michigan also makes them red stamp the policies. Boom! In red. This is placed with insurance not licensed by the state of Michigan. Any claims may not be guaranteed by the state of Michigan. There's all these little incentives. Scottsdale. They didn't go bankrupt, they just got the hell out of the city. That's a good company. Actually, they do a lot of different types of lines too. Professional and the other ones. All right, I'm not going to go on and on and on about this. I know, not sexy. Is it necessary? Surely a personal choice, or your mortgage choice, or the lender's choice, whether you want to insure a property or not. Different levels of insuring property. And this is, and a number of you actually have some of these, some of you do. Schedule. And then, Jeff, you had mentioned bundling. Like some companies will bundle them. They're not all on the same policy number. Each still has a separate policy number. But we actually can do scheduled policies, where it's one policy. People have referred to it as a master policy or blanket policy, where each location is scheduled under that policy. So we can get those down actually on fairly nice rates on some of those for multiple properties. Typically, we keep a higher deductible on those, $2,500. We call it catastrophic coverage. Some of them actually are nice, and we're familiar with banks and mortgage institutions. In fact, a lot of you are buying houses from them. While they own those, they have them insured in what we call an REO program. And they insure those on the same type of policy that I'm offering private investors. In fact, the fields and the applications and the same applications a bank would use to apply for insurance. And what the banks can do is they can force place insurance. You, the borrower, fail to maintain insurance, then they're notified. They can place insurance up to the loan amount on your behalf and charge you back. Well, I've got 4 companies now that I've got adapted to private investors, where we're using that type of policy where my clients actually get a login. Some do a lot of buying and selling. They can actually log in, add a property, They sell it, they log in, they take it off, they get a monthly prorated invoice by property for each of these. So they're just paying by the day. You like that, don't you?
I like that. It's really nice. It makes my bookkeeping nice.
We got two of them now. With two different companies. But that is, and the rates are actually, insuring in the city, multiple properties in the city is by far the best way, or the best rates I've seen out there. Typically, you know, look at insuring in the city on a single property, $50,000. Someone comes to me, he wants a $500,000 liability, $50,000, it's $1,200 a year. How can you get that under a scheduled property if they have 10 properties or so for 700, 750, 800 or 800 a year. So it's a significant savings on that side. The downside is a higher deductible, $2,500 deductible. There's co-insurance costs just like there is on all the others. But it's $1 million liability coverage as well. It's commercial, $1 million commercial general liability. So those work out nice on some of those larger accounts. Others buy and hold, you know, they're not buying and selling, but they'll do it. They just like the idea of paying monthly without service fees, and you're paying in arrears. You're not paying in advance, there's no down payment. I'm paying for last month, this month, I got to the 20th to pay for last month, you know, so it's kind of nice. People look at it, and you're only paying, typically you buy one, two, and, you know, they want 30% down plus, you know, 17% or $6, you know, per payment surcharge or whatever. So this is a nice way to do that too. Some actually, particularly a lot of my overseas clients, just with wiring transfers that they're paying, they'll pay annually, but if they're buying, they bought 3 houses last month, so this month they get billed for 3 annual premiums, you know, the premiums for 3 annual. They don't buy any next month, so they don't have to pay anything. Others just like to do it breakdown by month. There's a lot of different options to look at, so whether me or your insurance guy, ask questions, ask questions, ask questions. Explain the coverages. You know, they might get a little perturbed with you, but that's all right. We do that. Just be sure you know what you got. And I think that was the crux of your point, Jeremy, is, you know, just don't look at the premium. You know, think about the other considerations. Weigh your risk. You know, what's it worth to me, you know, to save $100? Do I want to assume a little bit more risk? If so, absolutely do so. But if I'm not comfortable with it, I can't put a price on your peace of mind, you know, or your level of risk. There's risk takers all over the place. You know, I rode motorcycle for 25 years, street bikes, Harleys. I wouldn't get on a bike today without a helmet. I don't get on my bicycle without a helmet today. But other people do. And I do believe they have a right. Although our PIP rates are going to, we got the highest PIP rates in the country, and they're just going to go up even more on auto insurance. Any questions?
Yes, absolutely.
Tom,
Chris,
Tony.
I'm not sure from your discussion early on the differences between replacement cost and actual cash value if I want to buy and hold long-term rental properties. Does that make a consideration which is more advantageous? And also you talked about if you're insured for much more than what you paid for it, you have a moral hazard. Moral hazard. But if you're underinsured, now you risk not getting your full coverage. So, which way do I want to go? Replacement cost, actual cash value, and how do I figure out how much I should be insured for?
Again, now if you want, it's typically the insurer or the agent. Someone comes to me, they want replacement cost coverage. Each company has their own model that you have to plug in, square footage, number of baths, you know, are they builder's grade, are they custom, semi-custom, kitchen, you know, how many kitchens, all this stuff. And we have to determine, we use this model, and it's a third-party model, it's not the company's model. It's a third party that administers this. They determine based on all that input what the replacement cost is for that house. And that's what we have to insure it for. Now, I know that there's agents and a lot of people will say, well, that's too much. And the agent will go back down, oh, well, okay, let me knock that custom kitchen down to builder's grade. Let me say only 1 bathroom instead of 3 bathrooms. To get that down, well, it's insured, and then sure, you get that model down, but you may have problems later on when they come back and say, you're underinsured, you didn't have insured for enough, and then it actually can go back to the agent. But it is your choice whether you want. Typically nicer homes, that are market value now, 100 to 150 and that. Some of my clients are insuring them at replacement cost. But one of the problems with that too is a lot of companies won't do it. If the purchase price is less than 65% of what you paid, or of the calculated replacement cost, unless it's a primary home. If it's owner occupied, well, some are actually limiting that too. But typically you don't have a problem with that if it's owner occupied. But if it's an investment property, you might have a problem even getting insured for replacement costs with some companies. But the cost, it is cost prohibitive as well. It is a personal choice.
And did you say that under replacement cost policy, they can still have a clause in there that can decrease that amount based on?
Yes.
Okay.
Yes.
And
yes.
so.
A lot will do, and they'll do a holdback on stuff too.
So how would you know that?
So they'll do a holdback. They'll say cut you a check or cut the contractor a check and this kind of stuff. And they'll wait till the actual job is completed. You show proof that it's completed before they'll release the additional funds up to the replacement cost. Because the clause will state that lesser of replacement, replace, if the repair or the replacement is not completed, they will pay based on actual cash value. So if you don't fix whatever's damaged, you're not going to get a check for the replacement cost of
Is
that
that pretty
damage.
typical? Is that
Yes.
to be expected in most insurance policies? So basically,
Even
you're,
homeowners'
if you're
policies
holding
are
a
the
piece of
same way.
property that you don't intend to, like this thing burns down, I'm just gonna sell the land, kind of an attitude towards property, then you shouldn't even consider the replacement.
Correct. Yeah. And they'll say, and I can typically go, say I got 50 into it. It's 1,000 square foot house. That's right around, $50 a square foot. I go up to $60,000. Got another $10,000 in there. Cost of demo.
And did I understand you to say that even under replacement value that they can depreciate that, or is that under the actual cash? Can they have a clause that they can still depreciate? Okay, well your house is 20 years old. And
no, the only way that they could reduce it in that sense on a replacement cost is if you had it underinsured. If you didn't insure it enough, that co-insurance could kick in.
Okay.
But there's no depreciation figured on a repair or replacement cost policy.
And co-insurance is pretty standard in a policy then too for that.
A lot of times it's buried way in
That's what I
there.
was
and
gonna
they
say,
will
rather
never
than
talk
get out that
about
fine
it.
print stuff and that big
It's not on
on
page
that
one.
on that Bible on that Bible type paper where
A lot will say too, they'll waive the co-insurance, but there's a minimum that you have to insure it for, which is the same thing as
Full
saying.
replacement value, yeah.
Here's a question for you. One of our properties, we have insurance on there, and I couldn't tell you right now if it's replacement cost or not. I think it is. On the policy, the breakdown of payments includes the exterior dwellings or exterior buildings, I guess, the garage.
oh the
And
garage.
Gail says, wait a minute, this building has.
Other structure.
Other
Right.
structures. And she says, what's that? That's the garage. It's covered $15,000.
And I said,
We don't have a
It doesn't have a
garage.
garage. I want,
Yeah.
and then she said, I'm sorry, I can't take it off. I said, well, I'd like to file a claim Cause my garage is.
Right.
And they wouldn't accept that either.
So, and that's a big one, it's like State Farm or, I forgot who that
Well,
was.
technically, you go back to say, well, I really don't have an insurable interest in that garage.
Well, they wouldn't take it off
That
because-
you're charging me for.
They wouldn't take it off, there's a breakdown of the cost, and they wouldn't take that off because that's the way it comes up in the computer. We automatically-
There was a separate line item?
Yes.
This cost?
With a separate price that we're covering, that
Because
that
most
piece
of
that
what
covers
my
costs.
companies will do is, it'll be a percentage of the main,
Right.
and it'll be included, it'll say included rather than additional premium, it'll say included. I have some of my companies actually, it is automatically included, but then you add an endorsement that removes that. And you get a little bit of credit. You know, $2, $3 or something. Something like that. But yeah, that's typically what they'll do. Now it's different though on their commercial policies. Most commercial policies will not, we don't even insure the secondary structures at all. And insure on that. But a lot of the personal lines, yeah, and we typically do them at, now some of my companies like Foremost, and I really like that because it's a choice. Okay, I can add it or I can not have it in there, you know, and you know, it might be $35. I know, Jesse, you've got some with, some without, you know, the garages and stuff, and it's like, you know, $30 a year or something to insure a garage for $7,500, you know, and it's not bad to have. But it's got to be detached. Now, if it's attached garage, it's all part of coverage A, which is the main structure. So it's all part. It's got to be other structure.
Well, this is non-existing and it's covered for $10,000, so.
Chris, the other thing that people need to keep in mind is that if you have things stored in the garage, they're not necessarily insured. For instance,
Very good point.
snowmobiles, boats, an antique car that you may not have regular coverage on. If the house burns down, unless you have coverage on those items, they're gone.
Personal property.
Right.
Right. So you, like, if you're renting the house, but the garage you're retaining, it, you're using it for your own storage. That's tricky, yeah. Now what you can do is, you can actually insure those on your homeowner's policy. You can schedule those items as personal items at a different location as well. So you'd have to schedule those on your homeowners. Or you can add personal property onto a dwelling policy, your personal property. But it's not automatically covered. Absolutely. Any other questions? Yes, sir.
How do I get coverage for a home that I own and I hire a contractor who has an employee that is not really an employee, just paying them cash, and he's not covered under workman's comp or anything, and the person gets hurt, and I'm liable because
You are.
suing me.
You are liable.
How do I get coverage for that?
You cannot get coverage for that unless you want to get coverage as a general contractor.
How do I get the contractor? What kind of coverage does a contractor have to have?
He's got to have general contractor's coverage and workers' comp if he has any employees.
How does he
Right,
verify
And that's
that?
another
Then
thing.
then he hires somebody who's not covered under workman's comp. How am I protected? How is he protected?
You're not
Fire the
protected.
contractors.
You're not protected. Basically, if you hire a contractor that's licensed and insured, they call it insured, you should have a copy of his current. You just ask, I need a certificate of insurance before you start
And what kind of
working.
insurance does he have to have?
He's got to have commercial general liability,
Commercial general liability insurance.
and work comp if he has any employees.
Here's what I do. I have a 3-page agreement that I sign with my general contractor. Their license has to be up to date, and exactly what he mentioned has to be on there. And they sign and notarize it that I'm requiring this of you, and you know, this is a requirement that you have this. So if he cancels it at any point in time, you know, the idea is if I get drug into court, why do you think I was paying the extra 15% to have this general contractor and this and this and this? And he signed right here saying he would have it. And you know, I can't say that would necessarily stand up, but that's what's in my general contractors
I mean,
agreements.
that's absolutely, you know, a level of protection for you.
And I do check. Now, I don't check that well actually. After they're in and they're good, you know, you quit checking. You develop a relationship. You're not checking on them all the time. But in the beginning, you know, I'm crawling up their butt with a flashlight, looking at everything. So,
And the courts will treat it differently too. If I'm a homeowner hiring a guy to, you know, put a new kitchen counter in my, you know, and one of the guys gets hurt, typically it could be a case against my homeowner's insurance if the guy's hurt on my property. But typically, you don't have to show or a certificate or be a certificate holder. Now, if you're a guy that's normally hiring the same guy to do rehabs on your houses, then the court will look at it, they'll view you as a general contractor. You're hiring this guy to do the work for you. So then, but he's not insured, therefore the liability will come up to you.
Chris, if I have this property insured and the insurance company knows I'm rehabbing this property and I have liability coverage, does the liability coverage protect me in any way if somebody gets hurt while they're on my property?
Contractors, if they're on there working, typically not, unless it's blatantly your fault, basically.
Okay, so that's the other side of that too, is if I'm negligent in some way, but if he just gets hurt due to he drops a piece of slate on his own foot, not due to any negligence on my part or of the house, obviously he can still come sue me. What's the chances of prevailing? So he has to prove I'm negligent in some way for him to sue me for damages,
Typically,
right?
but if I always encourage, I'm not an attorney.
Sure.
Did I say
No,
that
I'm not
before?
asking you to do it,
Did I say that before?
Yeah, right now.
Four
Yeah.
or five times. Speaking of liability exposure, I encourage, insured contractor, use insured contractors, use insured.
Protects you.
I take it a step further. Are you in this thing to be a real estate investor, or a property manager, or a tenant placement, or a general contractor? If you want to do it all and take on all the risk, that's fine. But there are a lot of benefits to hiring licensed, good people that you wouldn't have to worry about a lot of this. And then as a side benefit, you have a lot of extra time
There's
too.
a big thing about now, they just changed it last year with Michigan workers' compensation. A sole proprietor as a subcontractor. So if I have Joe hire Harry, he's my handyman. He does all the work on my houses. He does all this. He's not insured. The state of Michigan will view him, whether you 1099 him or not. 1099 has nothing to do with it. That's taxes.
Right.
That has nothing to do with liability. 1099 is because he's a subcontractor, means you can write it off as an expense. It doesn't mean that there's any liability in there. In the view of the courts, as far as working comps, he's still an employee of you, unless he has his own insurance.
Now, can you make a sub sign a waiver? Okay, I'm a licensed contractor and I'm insured and I have workers' comp to cover myself. Well, let's say my sub doesn't, because by law they can work under me with no license. But if he gets hurt on the job or something, is there any way I can have him sign a contract or a waiver saying if you get hurt, since you don't have this, that, and the other, I'm not responsible?
Well, typically, what they do on that, you can do that, and there's actually a form now. But if you're licensed, say a general contractor, or you're licensed, your company, okay, is buying houses and holding, you can actually get workers' compensation insurance. And then if you hire a sole proprietor, there's a form that he has to fill out and sign, and then that you retain. And you have to retain that, because if anything comes back to you, you can say, I've got this form, he's not on my work comp, he's on his own. And if he's not insured, it's tough, because I got this form saying that, and he signed it. And it's actually a form the state of Michigan workers' comp facility uses to do that, because they've just had so much.
Chris, what do they call that form? Where do you find that?
They call it independent contractors form. If you email me, and I've got them. Yeah.
All right, one more question. Although Chris will stick around for a while. Any more questions?
I'm sorry.
All right.
Good round of applause.